So I asked each of you to bring along a question, take me out of the frame, and to pitch a question to each other. So Andrew, you got a chance to ask Hamish a question that you've want to put to him. So why don't you let
go easy, Andrew?
No. So I think I'm always interested when people come into investment management from another area. I think it's a sort of a funny industry, and there's a lot of things about it that are unusual. And I was just interested in you've had enormous success with Magellan, but I'm just interested in what are the perspectives you think your former work brought or gave you coming into this industry.
Well, it's a really interesting question. I think it gave us two real things. How we organised our research was very much an investment banking sort of model, where we set it up in global sort of sector basis. And you've set it up in sector, but a lot of global managers do not set themselves up on a sector. They set it up in a very generalist or a country view of the world. And we came in with a view that it had to be a sector basis. And really we wanted very smart, very analytical people in that sort of research area, and we kind of built it pretty large from the start. So that was probably a lesson I took out of it. We did a lot of sort of valuations in terms of when we're investment banks on the advisory side, and we spent a lot of time interacting with management around strategy. So when we came in, we really thought about the strategy of the companies, and we got our analysts thinking about the strategies of the company. So that was pretty positive from investment bankers, but there's not all positives in investment banking. Here, what we kind of didn't want to do is create an investment banking culture. Partnership is not a concept that really exists inside an investment bank. All the incentives are completely skewed for bad outcomes for other stakeholders. In it, and we actually employed very, very few people from the investment banking industry. So what we said is, look, we've seen the good and we've seen the bad on investment banking. So we really tried to extract the good, and I would actually say a focus on risk as well was probably the other thing. Not the investment banks turned out to be incredibly good, but the focus on risk is important, and how we arranged our research efforts. But what we really said is we don't want an incentive system that would cause certain types of behaviour. So we got very, very focused on how we'd create the right incentives inside and the culture within Magellan, and we almost wanted to be the polar opposite of what we saw on investment banking.
Yeah, no, it's a really interesting point, because we've always seen that what's important for us in coming to a decision is this internal debate about the idea. But to have an open and honest debate about ideas, you've got to know that your team members are all coming at it with a genuine interest in getting the answer, not proving their point or knocking your stock out of the portfolio. Or, if you get internal competition, we compete with the world, and we all at Platinum, we all, I think, like competing and winning, but internally we're on the same team. And I think getting those incentives right and getting that culture right is really a very, very important.
Andrew, I'd be very interested maybe to reflect on an investment mistake in your career that you've done, and really what sort of lessons you took out of it. I think learning from our own mistakes is, we all make them. But what's something has stood out in your career of a mistake, and what's a sort of lesson you think investors should take out from that?
Yeah, so it's a great question, and the way I like to think about this is, the biases that we have that lead to these mistakes. And one of the classic problems that all humans have is confirmation bias. So we see in every bit of information that comes along the right outcome for what we're doing, and it's sometimes very easy to see in others when they're doing it. Very hard to see it in yourself. So, along the way, people always like individual stock stories about this, and I can think about, many, many years ago, we had a significant investment in Indonesia in residential property development, and this thing was, beautiful, had this great land bank, it was trading well below a, NAV and da-da-da. But what came along was the Asian crisis, the currency fell 90%, and this company had a small loan in US dollars that became a very massive one. And it's just, you sort of look at the behaviour. It's a very simple example from long ago, but I get worried when I see companies doing things that just sort of like, why are you buying that? Or why are you doing that? Doesn't make sense. And it might only be small and you can ignore it, but it's often a symptom of something else that's going on in their world. And I think you particularly see it in M&A where they go into something that sort of half makes sense, but is there really a coherent thought there? And I think it often indicates that a company's can sort of see the writing on the wall with their ongoing business, even if it's 4 or 5 years out. So, but in aggregate, it's sort of like that confirmation bias is just something that we're all fighting all the time, I think.
Oh, I completely agree with you.
What techniques do you use for you as well, Hamish? What sort of techniques do you use to manage your biases? Because it's probably one of the things that comes up most consistently within our readership as something that they feel like they're susceptible to. Do you use specific techniques, or are you just aware of it?
I think, there are some sort of tools that you can use, but really for us, it's about having this, very robust internal debate and an insistence that you write the case down for why you're doing what you're doing. And the reason I find that very powerful, it's probably more powerful for the introverts amongst us, is that you can talk in great terms about this company and why it's extraordinary and it's going to be a great opportunity, but the moment you start writing it down, you start going, can I say that? So I think, we then will, get that case on paper, we'll debate it and try and get many, different points of view there. And then because we have a number of portfolios who can all own the same stock, one of the most interesting things that we have is that if I'm buying Micron but Clay Smolinski's not, or Alex Barbie, who runs our tech fund, is not, we're all experienced investors. We've all got access to exactly the same information and debate and discussion, but we come up with different points of view. That's worthy of a very significant effort to try and pull that apart. Now, we don't go to consensus. Sometimes we will have those differences and we let them stay, but you certainly don't want, there's a lot of unstated. Experienced investors will look at a situation and go, I don't really like that. That's not very helpful. You need to get out of them why they don't like it. What is it in their experiences that's leading them to that conclusion? So that's essentially the process that we use internally to try and come to remove those problems, but they still remain.
Hamish, do you suffer any biases as an investor, or some that you find yourself repeat patterns of behaviour that you have when it comes to putting stocks in the portfolio, managing the fund?
Look, in terms of heuristic biases, it's something that I've always been incredibly focused on. It's very hard because we're hardwired naturally to have these biases, to take shortcuts and do certain things. If people went to the front page of our website, one of the things I wrote a long time ago was a whole series of investing biases that I think are very important. I often reread them and I often resend them to the team. There's a series of probably the more important ones. Here, confirmation bias, of course, one I'd put sort of groupthink very much in the confirmation bias. And what worries me more is when we kind of get everyone on the same page on a topic. So, and I'm very sensitive to when we starting to get groupthink, but that's probably one of the most dangerous ones when you start getting a whole lot of people who have a conviction that we're right, and there's not kind of a voice saying, "Hey, hang on," and that can be dangerous. Another one I would say is oversimplification is a problem, and therefore things that are incredibly complex And a lot of banks are incredibly complex, and sometimes I would sit down and I will read a 400-page 10K on a bank just as a reminder about how little you actually understand about them, which is a thing. You can be simplified into investment case and look at price to book multiple and everything else, but sometimes you need a reminding of just how much you really understand. There's other biases, anchoring biases. Here, I think we're fairly good at not being anchored. You know, I have a team around me to try and overcome some biases. I've chosen their personality. Some of them will deliberately take contrary views nearly all the time to mine, but with analytics. So I think that's very important that you're testing the other cases. And something I've learned a lot about is another bias I've written about is neglect of probability. And you know, I've made mistakes. I think the biggest mistake I made around Brexit on neglect of probability, we held some investments in the UK. All the opinion polls were telling us that the Remain vote would get through. We had some investments there, and because of all that information was coming in that it looked very likely it was in, the problem is the polls were very close, but everyone thought it would be slightly over 50%, which means there was almost a 50% probability that something else was going to happen. And the something else was going to happen was potentially very ugly in terms of what would happen to the pound, and we owned Lloyds Bank at the time in that. And that was an experience about assessing the probabilities and actually really looking at the alternative cases when the probabilities are anywhere material. But you know, some of these, that was a bias. And I always talk about probabilities and scenarios, and one that was staring me in the face, it was so obvious, lo and behold, your biases came in and we got it wrong. Yeah. I wouldn't use we, I got it wrong.
Yeah. I really like your comment, Hamish, about, you know, when everyone's sort of convinced that this is a great idea. And so, you know, we have our stock meetings, and I'd say the best ones are when you know, there'll be 5, 6, 7 people there, and if 7 people walk out of the room going, this is great, it's invariably terrible because they haven't seen, you know, the weak side of the case. The best ones are where generally, you know, the analyst is firm in their view, they've done the work, they've spent, you know, weeks, months potentially going through the case, and at best they just manage to drag the PMs over the line to do something. They're invariably the good ones, because if you don't have some of that, you know, in uncertainty around why this is good, you know, it's sort of obvious to the world.
It's the uncertainty that creates the opportunity in the
Absolutely.
price, right?
Yeah.
Listen, we're going to wrap up because we've got a few of the audience questions which we're going to run through. So the rules here are we need to keep it pretty short and sharp.
A problem with both of us. So.
Yeah.
Guilty as charged.
All right, well, we're talking about global investing, currency movements. How do you manage the risk or the opportunity with regards to currency, Andrew?
So look, we I guess see our neutral position as having no hedges on. If we're in Japanese stocks, we'll be exposed to the yen. But there will be occasions where, you know, we really think currencies are at an extreme, and they actually may be giving you opportunities. For example, the yen's been very strong in the past. It was a great opportunity to buy exporters, but you obviously want to take the view that the yen will weaken out of the equation, so you'll hedge it. Other examples would be in China at the moment, where we have a significant exposure. One of the release valves for that economy, if really things do not unfold well, would be to let their currency weaken. And so if that doesn't happen and the currency is a bit stronger, that's fine, but we've hedged some of that out, because I think our stocks will be doing very well. But on the other side, if the currency does weaken, you know, we're protected from that. So, but by and large, you want to sort of have a very strong view for doing anything in currencies. I think if you're playing around here and there based on your view on rates or growth or whatever, I think that's a zero-sum game for the market, and for those who participate in that, I think you're more likely to give away.
Well, first of all, I'd say is any long-term investor shouldn't get too concerned about the currency, and the reason I say that is because currencies don't compound. at the end of the day. They have one-off sort of adjustments around their mean. So if you're looking over to get a 10% return per annum and you achieve that over time, that means every 7 years your portfolio's doubling, but a 20% currency movement is going to take 20% off a doubling, assuming you've, at the starting point to the end point, you've had that adjustment. And taken in the context on a per annum basis, that currency shift in a long-term portfolio just isn't that material. I think there is a genuine diversification benefit to having some unhedged currency exposure, because we live in a country with a commodity-related currency, and tends to what happens when the world has a real problem, the $A tends to fall, and when the $A falling, your offshore investments back in $A are worth more, so you tend to get a bit of a protection around that. I can agree with Andrew, at the extremes when the dollar was at parity, you'd be mad to have had any sort of currency hedges on. If the dollar's at 60 cents, you could, we don't actively manage that outside our high conviction strategy around those extremes, but they can be quite obvious. And we offer both a currency hedged and unhedged product, so you could actually switch between it at those extremes. But I think you can get overly caught up. There is a genuine diversification benefit, and overly caught up the difference between the compounding effect of the earnings growth of the companies versus a one-off adjustment of the currency. And it's over a long period of time, it's actually not that material.
No, that's absolutely right.
Next question. ETF flows and the growth of them, have they created more opportunities for active management?
Look, I wouldn't say it's just ETFs. I think by definition, the more and more of the market that goes to ETF, there's fewer and fewer active managers that are going to be there. And I think for active management, that's actually a good thing for people who are skilled in running portfolios. By definition, it's going to have to make the markets more efficient. If everything went to passive, even the bad companies, nothing would be reflected in the price. So the markets would be completely inefficient if everything was 100% passive. So just by definition, more and more markets that's been taken up passive, there's less room for as many active firms. I'd also argue what's happening with MiFID II, effectively putting a cost on research and making research effectively a barrier to entry for smaller, bright teams who spin out, who are going to have to pay for their own research. That is also potentially going to make the markets more inefficient. It's probably very good for a Platinum or Magellan who's got the capability to hire people. We pay for our own research, and it doesn't worry us at all, MiFID II, but there's a number of things that ultimately are probably leading to some skilled active managers, creating that this industry is always going to exist in the future.
I think the move, if we think of ETFs as passive, that's our opportunity, that there's less and less people looking for these opportunities. I'd actually say that one of the really interesting things about passive, and you sort of can't deny the logic of, the average active manager doesn't outperform over time. But
which definitionally has to be correct.
Right. But it doesn't answer the question of whether I should be in the market or not. And I think at the core of probably both our investment approaches is we're not there saying, we're expected to do better than the market, but that's not what we're trying to do. I'm saying to you that Micron today, I think, has an implied return of the order of 20 to 30% per annum over the next 5 years. You would have a sense of what you're expecting from Facebook or whatever, but we're making that judgment on that stock against, if you like, the US 10-year or the Australian 10-year, whatever it is. I think it will do better than the market through time. But if you're going to go passive, you're assuming that you're going to make money from the market. Well, ask a Japanese investor who went passive in 1989 how that went for them. It's not surprising that passive's not very popular in that part of the world. That part of the world.
Alrighty.
So these aren't the short answers.
Yeah. Well, we're going to go this geographically, Asia or America. Which area has the brightest future?
I think both the US and China have extraordinary potential. They are the two dynamic economies in the world. That's where opportunities come from. There's a reason for Silicon Valley's existence. There's a reason why China is doing so well in many of the same areas. I think they're the two great opportunities.
It's not binary, it's not one or the other.
It's not. And then you'll see other parts of Asia, Japan, the economy's doing better, but it doesn't have that dynamism that those two places have, nor does Italy. But then somewhere like Germany's pretty good. So I think it's all about, in the world we're in, you need that entrepreneurial zeal and the desire to, find the new thing.
Yeah, I would very much agree with Andrew. We are very bullish on the long-term outlook for China and the opportunities the Chinese economy. It's a massive economy with a massive educated population, with a growing and probably will be the world's largest domestic market. And just the US has currently got the world's largest domestic market. So I think both of those economies have massive long-term strategic advantages. But at the end of the day, it's not about investing in economies, it's about investing in individual companies.
Yep.
At present, I would say, for various reasons, some of the leading American companies have an edge. From governance reasons, from talent reasons, from incentive systems, from a whole series of things. But there are going to be great Chinese companies that come up through that, with the massive sort of domestic market and everything they have, and the technology and the education system in China. And there can be some amazing businesses in China. But on a global scale at the moment, many of the very large leading American companies do have an edge, and those edges aren't going to suddenly disappear overnight.
Very quickly, you got up to the top of your cash threshold, or what the fund is in the mandate at 20% level. Would you have liked to have been able to go higher?
Look, at the end of the day, in our core product, which is the Magellan Global Fund, cash is a risk position as well. So, holding very substantial amounts of cash for extended periods of time is a 20% position at max in our portfolios. So people have to understand cash isn't some sort of riskless asset. It's not going to earn our investment returns through cycle by taking very large positions in cash, and I wouldn't go anywhere near 20% in a single stock. So I think it's a pretty substantial part of an equity portfolio, 20%. I feel very comfortable. Now, high conviction fund, I can go greater than that, but that's kind of a very, very targeted, it's 8 to 12 stocks, so it's a very different thing. But in a core product, I think 20% is a big position to be taking in any single asset in your portfolio, and I feel very comfortable about that.
Andrew, after a tough 2018, how much capital is going back into Asia now?
From our perspective,
and outside of your own perspective.
Oh, look, I mean, we have, as I was saying earlier, we've really been changing the portfolio over, so probably no more capital has gone into Asia than where we were a year ago, but some of the names have most certainly changed. But we are, in terms of the market, you are seeing today the early signs of a pickup from investors coming back into Hong Kong and the Chinese A-share market. That's starting to happen, but you never know whether that goes on.
Okay. Final question for each of you. What's the most significant opportunity in the market that no one is talking about?
I would keep coming back to these semiconductor companies that we've been buying. To be buying these companies that are at the core of everything we do, and yes, they're cyclical to a degree, but okay, today we're probably paying 30% above book value, but all because we're scared about the year ahead. Earnings are going to be down this year. But the valuations, I have not seen valuations for companies of this quality in my 30 years. I just think they're extraordinary, and there's a whole grouping of companies around them that I think are very similarly very, very cheap.
Right. Hamish?
Well, I really can't answer that question, James, because I'm not really aware of a big opportunity that actually no one's talking about. Whether people have valued it correctly or not valued it correctly. Obviously, there's massive uncertainty about future regulation and things that creates people are all over that debate in terms of technology and things of where that is. I would actually argue in the big cloud computing side of things, I don't think people understand the duration of it. So everyone's talking about it, but I don't think many people really focus on a decade or 20 years in terms of really the scale of the investment opportunity. So while people are talking about it, that's what I'm saying, I can't really answer the question because many people are talking about it. I don't think people get the duration of the investment opportunity and can value that to the scale that it is. But is anyone not talking about it? No, there's not many things we're looking at that I don't think people sometimes what we call duration arbitrage. They don't actually get the value in the duration of it because markets tend to be much more short-term focused. But am I saying we've identified something like this and no one else has worked it out? No, because we take a longer-term view, we actually can see value that others aren't prepared to invest in. But it's not like we've got an insight that we're the only people in the world who can see this.
I think we're in a world now, maybe 25 years ago, people hadn't talked about, a new emerging market or some thing that was happening in tech. But today, I mean, we are saturated in, so there's nothing much left undiscussed.
You mentioned gene editing. Gene editing is incredibly, and gene therapy and things, Novartis is in both these spaces, incredibly exciting, and you can do a lot of research. And you probably find great opportunities by doing that. But it's something no one's talked about.
No, everyone's talking about it. It's just a question of what they're, whether they actually have the insight as to where the final destination is.
A fair answer. Well, gentlemen, thank you both for presenting the opportunity to come and have a chat with two great Australian global investment firms, and appreciate your candour and taking on the challenge of putting a few questions to each other as well. So thank you very much.
No, thank you.
Thanks, James.
Yeah.